Welcome to the How to Build Your Trading Account with $5,000 by Traders Help Desk. Now, I want everyone to read the disclaimer. Futures, stocks, and spot currency tradings have large potential rewards, but also large potential risk. I highly advise that you do not trade with money you cannot afford to lose. And everything shown in this presentation is based on hypothetical performance. Typical issues that traders face include such issues as which markets do I trade? What do the professionals really mean by cut your losses short and let your profits run? As well as the trend is your friend. Which time frames do we trade? There's tick charts, minute charts, volume charts, Renko charts, range charts. Which ones are best for us? And should we look at the quantity of trades or the quality of trades? This all makes an impact in your trading. Well, the first thing that we're going to do is start with a money management of 2% of our total account for risk. Since we are using a $5,000 account, our total risk is $100. Now, the reason that we do this is important. We need to make sure that we are in trading as a business and that we have money in the account to sustain losses, okay? We're not always going to have winning trades. We're going to have losses too. We need to make sure that those losses do not devastate our account. And this is a lot of times where traders fail. They don't understand money management. They'll take a $5,000 account and they'll say, oh, I can risk $500. Well, if you risked $500, that would be 10% of your account, and you're not going to be around for very long. So we're going to limit this to 2%. Very important. Now, we're going to do a market research. Okay? Instead of relying on what everyone else tells us to trade, we're actually going to do some research and see which instrument is best for our needs. Now, we're going to start out by looking at the volume, okay? What is the instrument that has the best volume for us to trade? As you can see on the chart, the mini S&P 500 has the most volume, followed by the Nasdaq, followed by the Russell, then the Dow, and then finally the EMD, which is the mini S&P 400 mid-cap 400, sorry about that. So the one that I definitely would not trade would be the EMD or the mini S&P mid-cap 400, and that is because it has the lowest volume. When you get into a contract that has low volume, you're also getting in for more slippage than you do with the other contracts. So we know that we cannot trade the EMD, but we could trade the ES, the Dow, the Nasdaq, or the Russell. Now that we have looked at volume, we also want to look at tick. In other words, how much movement does each market have? Now that's very, very important because we need to make sure that we can make profits. As you can see, the mini S&P 500, which had the highest volume, actually has the lowest movement. Now, the Dow actually has the highest movement, followed by the Russell, the EMD, and the Nasdaq. And again, the mini S&P 500, of course, is the lowest. Highest in volume, but lowest in movement. Since each of these symbols have a different tick value, we also need to see, okay, which one gives us the most dollars? That's what we're interested in, dollars. That's what's going to increase our account. So the first thing that we look at, again, is since 2003, which indices market has had the most dollar amount? And as you can see, it is the Russell, followed by the EMD, followed by the S&P 500, and then the Dow and the Nasdaq. As you remember, we've already said we're not going to trade the EMD, which is the mini S&P mid-cap 400, because it has the lowest volume. The ES has the most volume but has the less tick movement as well as dollar amounts. So according to this chart, my first choice would be the Russell, and my second choice would actually be the Dow. Now, when do the markets move? Everybody wants to trade in the morning session, but is that really the best session to trade? Because you have all the different market reports coming out in the mornings. So is that the best time for us to trade? Does the markets move the same in the afternoon? As you can see from the chart, they actually move a little bit more in the afternoon, but the advantage of the afternoon session is you don't have all the market reports being released. So you may have a better trending market in the afternoon when there's no reports coming out versus the morning session, which are normally back-to-back market reports. Now we need to look at what type of trader are we. Are we a high volume trader, meaning we're going to trade more than 50 contracts, and liquidity would be our main concern? In other words, could we get in and out with 50 contracts? Considering that we're only trading a $5,000 account, we're limited to one contract. So we are what I consider an average trader. We are more interested in the dollars and not the liquidity. Okay, now that we know our money management, we know which markets we're going to trade, we need to make sure that we use the proper risk to reward ratio. Again, this is where a lot of traders make mistakes. A lot of traders actually will use a risk to reward that is what I consider inverse. That means they're willing to risk more than what the reward is. What this does to your account is it means that you have to have a higher accuracy rate because you're risking more per trade than what you're actually getting in return. Since we are probably new traders, we are going to make sure that we use the proper risk to reward, which is 1 to 2. This means for every dollar of risk, we are going to make $2 as a reward. This means that we are going to cover our losses because we're always going to get double what we are risking. Now, how do we set our profit targets? This was a big issue for me and a lot of other traders. How do you set your profit targets and your stops? What I do is use what I call a 10% rule. That means that I take 10% of the average daily movement for the last 254 days, and that is my profit target. I divide that number by 2, and that gives me my stop. It's a very logical methodology that you can use just about on any market. As you can see from the chart, the Russell has a profit target of 1.5 points and has a stop of 8 ticks. And again, the EMD is also rated in there. However, we are not trading the EMD because of the low volume. And I like to always average up on this, so I'm going to use 1.6, which is the perfect 1 to 2 risk to reward ratio. Now we're going to go through a couple of scenarios to see what this will do to our account, and I want to go through the guidelines first. We are going to do 8 trades per week beginning with 1 contract. We need $4,000 in our account for each additional contract traded. So to trade 1 contract we need $4,000. To trade 2 contracts we need $8,000. We are going to use an 8-tick stop and a 16-tick profit target. Our risk to reward again will be 1 to 2. Now, the scenario number 1, we're going to have a win-loss percentage of 50%. We're going to have 4 negative trades, followed by 4 positive trades. In any break-even trade means that we have covered the cost of the trade, but we have not increased or decreased our account. Therefore, break-even trades are considered moot and are not counted as our 8 trades. Now, what would this do to our account? That's the bottom line. As you can see, by July 1st, we have doubled our account, and by the end of the year, we are trading 10 contracts, and we have made a little over $50,000. Again, this is based on a 50% win-loss ratio.